We've made it through the start of another earnings season, so it's time to check in with our weekly scorecard. There were some major market players that reported earnings this week, including IBM and Goldman Sachs. Now, of the 83 companies in the S&P 500 that have reported so far, more than 60% were above analyst expectations, and less than 23% of them reported below estimates. Revenues, on the other hand, aren't faring quite as well. A little more than half of the companies reported above analyst expectations, and about 48% of them came in below estimates. So to bring this into perspective, this was a decent start to the earnings season. Typically, 62% of companies beat earnings expectations, along with beating revenue estimates. Now, looking ahead to next week, we have some more big quarterly reports coming out from the likes of Facebook and Netflix. Let's kick things off with Facebook, shall we? Expectations are high, as the social networking company has been posting significant growth over the last year. On Wednesday, shareholders will be mostly concerned with the balance sheet instead of the drumbeat of headlines from all of their recent big-time acquisitions. Investors want to see revenue growth of more than 60% year over year. The general analyst consensus on Wall Street is they want to see earnings per share of 24 cents on $2.35 billion in revenues. This will be about double what the company posted in the same quarter last year. Now, at last check, Facebook stock was trading down at more than 1.25%. Providing investors with eye-popping numbers means they must go beyond just growth. Simply meeting expectations probably won't be enough to keep its stock racing upwards. Now, transitioning over to Netflix, they're facing intense competition from the likes of Amazon, Hulu Plus, and HBO. The name of the game here is subscriber growth, and that's what investors want to see. Netflix's agreement with Comcast to pay a fee for improved streaming quality is also expected to increase its operating costs, which may compel them to increase subscription pricing, possibly having a negative effect on subscriber growth. On Monday, analysts are expecting 83 cents a share on $1.27 billion in revenues. This would be up from the $1.02 billion in revenues from a year earlier. Now, at last check, the stock was trading up at more than 4%. Netflix's growing subscriber base will continue to be a major growth factor in the near term. The company's partnerships with cable television providers Virgin Media in the UK and Comhem in Sweden will boost their international subscriber base going forward. So that's a look at two companies we'll be watching next week. For The Street, I'm Corey Hale in New York.